Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The wonderful part about talking to Mihir Vora is that there is a great combination of both micro and macro, and equities and non equities, and both of them will equal aplomb. And in fact, that's what I'll try to do in the conversation today. So, for the talking point today, we'll try and ask him questions centered around whether markets are showing a hope rally, equities that is, or climbing a wall of worry. Is the trade data pointing towards a consumption slowdown, or is this heartening that services exports have shown such a strong outperformance? Are financials still the best game in town? We'll talk about whether IT stocks can reverse the losses of 2022 as they are showing signs of in the first 1.5 months of 2023. And of course, the top themes to bet on as per him and his firm. Mihir Vora, he's Senior Director and CIO of Max Life Insurance, joins us right now on the show. Mihir, great having you. Thanks for joining in. Hope all is well.
Absolutely. It's a pleasure to be here, Neeraj. I hope
Thank you
you're
so
doing
much,
well
Mihir.
too.
Mihir, can I start off with we haven't spoken since budget. I think it was a status quo of sorts on most things macro, but you've now had 15 days to digest the budget, the RBI policy, and the few other micro events that were center stage even around budget time. What do you make of the current investing landscape?
So I think it's more of the same in the sense we've maintained that the domestic economy is on a relatively much sounder footing than the global environment. So I think the budget also takes into cognizance that we will see decent nominal GDP growth rate, about 10 to 11%. Tax collections will continue at a certain pace. And I think instead of tinkering around too much with micro stuff, the finance minister has just more or less maintained status quo, given some relief to the urban middle class by hiking the taxable slab to 7 lakhs and thereabout. But it's a budget for continuity. I wouldn't read too much into it in terms of disruptions.
What about the policy, Mihir? I mean, there's a surprise leaving the door open for some more hikes by the RBI governor. Now, does that in any fashion disrupt the equations that people would have laid around equities, financials, NBFCs, so on and so forth?
Uh, so I think just about the policy, which has nothing to do with equities. On the policy, given the global uncertainties, the Ukraine situation is still not off. You might see global geopolitical uncertainties, oil again volatile at some point in time. So yeah, I think it's only right that the RBI keeps all its options open rather than completely going one way, dovish or completely hawkish. I think they'll be more data dependent and try to balance growth and inflation, because even in the US, if you look at the last couple of prints, inflation is still not under control at a comfortable level. Yesterday again, the US economy retail sales data came out. They were quite much stronger than expected. So inflation is high, growth is strong in the US. So to that extent, there is a case that you might see some more tightening by global central banks. And I think it's only right that the RBI keeps all its options open and not become too dovish too early.
Hmm.
Uh,
Okay, the
on the
reason,
on
sorry,
the on the
yeah.
impact of all this, the budget and the MPC, I think that's what you were alluding to. I think the equity markets more or less depend on growth rather than interest rates. So I would not use this equation of rising interest rates is bad for equity valuations. No, it doesn't work that way in India. I think the markets only worry about growth, earnings growth, and that's what I think is looking comfortable at this point in time. So we have a reasonably decent setup for equities to perform if nothing goes wrong on the global side.
Hmm. Is that a worry in your mind, Mihir? What is it that worries you the most when you look at the global landscape?
I think inflation is the main thing that I'm looking at, and a hard landing in the US is a risk. So our base case is not that of a very hard landing in the US. I don't think the markets are discounting that. But if it really tanks beyond expectations, then that would be a worry for us, because we have been held up reasonably well by goods and services exports. Oil coming down is a positive for us. But if that goes against us, then obviously there's an issue. So I'd say a Goldilocks situation would be lukewarm kind of growth in the US, Fed not get doing too much too aggressively, and then India continues on its own growth path based on its domestic economy. That would be the Goldilocks situation.
We were so there's been a bit of a pullback in the last 3 4 days, but that notwithstanding, we were talking to J.P. Morgan yesterday. I was reading a couple of other notes last week as well. There seems to be a belief that uh, maybe the global markets have climbed ahead of themselves and there might be a corrective move. My larger question is that if indeed the world markets stay undecided, caught between a hard landing and a soft landing, and if indeed there is a withdrawal of liquidity from equities at large, does it create the possibility of the Indian markets having a rerun of what happened in 2022, which is a flatline year, but maybe even more narrower, as the withdrawal of liquidity would mean that a lot of broader market stocks might just not find favor at all? Do you see that possibility, or do you believe it will be a broad based move, if at all?
So if we are talking about the soft landing, then there is no need for a very sharp withdrawal of liquidity, frankly speaking, because we also must realize that the Western world is kind of tied itself in knots by the really extremely high debt levels out there, whether it's at the sovereign level or at the corporate level. So to that extent, they have gotten used to very low interest rates. Their economies cannot sustain the 10-year bond yield at 4 or 5%. It cannot happen. So to that extent, I would take a very sharp hike or very tight liquidity condition as the base case. If it happens, it would be in extreme conditions like the Ukraine situation causes such disruption in commodity prices that inflation goes back to 6 7%, like we saw last year. Then we should worry about it, but not if inflation is at 4% or 2%.
Okay. So, do you reckon that there is a probability of equities giving meaningful positive returns in 2023 from where we are currently, or is it difficult to predict that, Mihir? What is your base case? Indian
for
equities.
for India, I think it's possible, because if you just look at the broader, no, the larger indices, say Nifty 50 or Nifty 100, then you still are dominated by financials and IT, and of course, then you have the commodities and consumer discretionary and FMC stocks. So if I look at sector by sector, there is good earnings visibility. So 15 to 17% earnings growth for next year is a distinct possibility, not too much of a stretch. Valuations are a little above average, so not very comfortable, but not very alarming either. So as long as there is no major disruption in the global markets, there is a good base for us. And we have typically seen if large caps perform, then after a few months of lag, even the mid caps and small caps do tend to catch up.
Okay, got it. Okay, so that's the base case. In that scenario, I heard you speak about the two spaces that I really wanted to ask you about in addition to others. So first is financials. Now, two things out there. The reason I was even trying to link the policy a little bit here is that a bunch of notes stated that if indeed we reach a scenario of peak rates, then maybe NBFCs become a bit more attractive. Also, penciled in is the belief that the best of the net interest margin picture for banks may be behind, and we might say NIM compression, and therefore banks may not necessarily be the best place to be in versus some of the other themes. What are your thoughts on financials at large?
I would tend to agree with that thesis. That NBFCs have underperformed for quite a bit of time, and if as we discussed, the RBI, while it has kept its option open, but if we see normalization or at least a reduction in the late part of this year or early part of next year in the RBI policy rates, if that starts getting built in, then even NBFCs should not be too much of an issue. I think what matters not is the absolute level of interest rates alone, frankly speaking. It's also how RBI manages liquidity in the system. So while interest rates is an important component, I think operationally and tactically, it's liquidity also which tends to impact borrowing costs more directly. And we are kind of seeing a balance at this point in time. So we'll have to see the signaling from the RBI. So if liquidity is not kept very tight, then I would not worry that much about absolute levels of rates, because ultimately if growth is there, then whether it's bank or NBFCs, they somehow manage to maintain their margins. I have not seen margin compression because of competition, frankly speaking.
Wow. Okay. And you seem to be constructive about growth in India. I've heard you now twice speaking about growth looking okay when it comes to India.
Yeah, I mean,
Earnings growth
okay,
not.
yeah, absolutely. So GDP growth again, we are talking about 5.5 to 6%, which is decent compared to the rest of the world. Not spectacular. I would obviously, for a country like India, long term we need to be closer to 7% or more. But even six in the current situation is not too bad. And I think if we do about 6% GDP growth, then 15% earnings growth is distinctly possible, because we are talking about say 11% nominal growth and a bit of extra over that as far as earnings. So I think it's not too much of a stretch, I would say. And valuations, as we discussed, are not that expensive.
Okay. There is a bit of a dichotomous view and a very stark one around information technology, the second most heavyweight sector. Where are you on your stance on information technology?
So last year we went underweight, but then the stocks have corrected quite a lot, kind of similar to what happened in NBFCs. They underperformed quite a lot versus banks. IT stocks have underperformed quite a lot versus the rest of the market. And we are not seeing much more incremental uh, negatives from coming out from the US. So I'd be more neutral at this point in time rather than very underweight.
So where is it, Mihir, that you are most constructive on? I think financials was a pocket that you mentioned, but if you are neutral IT, where is it that you believe what will ride or what will take the indices higher from where we are currently?
So it's the domestics basically, whether it's banking and financials, which is of course the large part. But we are talking about industrials. We are talking about consumer discretionary. Not so much of consumer staples. There we do see some sluggishness even there at the lower end of consumption. But discretionary, which is like autos and industrials across the spectrum, whether it's EPC companies, capital good companies, defense companies. Defense is one of our key bets. We have a significant overweight there. So these are the essentially the domestic themes and domestic infra spending, capex spending, private sector spending, real estate, and domestic discretionary like autos, etc. That's where we would focus on.
Okay. Here, my final question, and that is how people get stuck upon fairly short term moves. And through one of your tweets, you had spoken about or you had brought out this whole piece around how, if you just looked at the last few years, all that has been Japan's loss has been India's gain. Largely, Indian markets have climbed walls of worry, even if the gains might have been muted. My question is, do you reckon, if as you look out towards this decade, do you reckon the gains over the slightly longer term, if all goes right, of course, can be much more pronounced? And should people kind of look at that? Don't miss the woods for the trees, so to say.
It will be because there are a couple of engines that are likely to fire, and one is structural. Even the government can't do anything about it, which is demographics. So demographics is something that's on our side. Nobody can mess that up. We are going to be adding the largest number of working age humans in the planet over the next 10 to 20 years. China is already begun to degrow its working age population. So that's one huge production capacity that we have, as well as consumption capacity that we have, which no other country in the world can boast of. So that's one. And second is the government's very very sharp focus on domestic production through PLI, defense indigenization, lower corporate tax rates. So I think those all will add up in due course. So we are already seeing some action on the ground. Defense is again, as I said, a very sharp focus. So all this put together, create a good structural story. I don't think capital will be a problem for India. So services exports are anyway doing very well. If we manage to reduce the goods deficit on the trade side by more local manufacturing, that can create that extra delta from 6% GDP growth rate to 7 or 8%. And I see a good chance of that happening sometime in the next few years.
Great. Mihir, on that note, thank you so much for taking the time out and speaking to us today on Talking Point. Lovely having you as always.
Thank you for having me. Always a pleasure.
Pleasure was ours. Viewers, thanks for tuning in.